All right. Well, hello and good morning to everyone who's joining us today. We're so appreciative that you're here. My name is Ellie Burns. I am the Senior Director of Nonprofit Relations at the Community Foundation, and I am so excited to welcome our friend Kelly Gottner from Connectify HR to share a little bit about demystifying the new overtime rules. I know we have a large audience, so we're obviously it's a question many of you have pressing, and so happy to cover this topic for you. Just a few housekeeping items, and then I'll go ahead and introduce Kelly and hand it over to her. If you have questions as we go, feel free to unmute and ask or pop them in the chat. I'll try to keep an eye on the chat box and share those questions with Kelly. We'll also have time at the end for questions, so if you want to hold your question to the end, that's fine too. So thank you for being here, Kelly. Kelly Gottner has over 20 years of experience in human resources in various roles and industries. She earned a bachelor's degree of arts in business and human resource management from the University of Northern Iowa, and she holds a certificate in strategic HR leadership from Cornell University. Kelly is a talent management certified professional and is a senior certified professional through the Society of Human Resource Management and the Human Resources Certification Institute. Kelly serves as the Connectify HR's Chief HR and Client Experience Officer. Connectify HR is a Des Moines-based PEO that focuses on providing HR, payroll, and benefit solutions and services to businesses both in Iowa and nationally. Kelly also serves on the state of Iowa's Workforce Development Board and the Greater Des Moines Partnership's Talent Development Board. So, Kelly, you are obviously highly knowledgeable in this area, and we're excited to learn from you. So I will pass it over to you. Thank you.
Great. Thank you so much, Ellie. Well, good afternoon, everybody. I'm so happy to be here. Just a show of hands, or if you don't have your camera on, you can raise it in your office. How many of you feel like this about this topic? I know I do, and I'm an HR professional by trade. Or how about this? HR is complex. Employing humans and employing others within your organizations is complex. And so it's things like these that just elevate the complexities of employment. So I'm hopeful at the end of our time together that you'll feel a bit more prepared and informed to navigate our organization, to navigate your organization through these complexities. We will have time, as Ellie mentioned, for questions kind of throughout. So feel free to ask those as we go, or feel free to save them for the end. So we're going to look at several things today. We're going to start with exactly what is changing with the final rule and who is impacted. And by the final rule, what I mean by that is the Fair Labor Standards Act, specifically the overtime rules, and related to that, the exemptions of those whom you can pay on a salary basis. So we'll look again, shifting to that focus to who is going to be impacted. And then we'll look at evaluating options for compliance. As you may have seen in news networks, probably organizations, other employers that you're talking to, some of these regulations are already caught up in legal challenges and legal battles. So TBD on in terms of if all of these regulations will actually go through, but we're going to evaluate them today as though they are. And then finally, we'll just look at actions and key takeaways that you can use back within your organization. Slides are not advancing. There we go. So a little bit of background, and some of you may recall during the President Obama administration in 2016, the DOL sought to increase the salary level test in 2016. So similar to what we're seeing today, but in 2016. And if you'll recall, that ended up being enjoined in the court, so it did not go anywhere. The DOL subsequently updated the white collar regulation. So again, those salary exemptions in 2019, which is what the current salary threshold is today. So what's changing? with this law that goes into effect July 1st, which is literally right around the corner, it increases the standard salary level, which is currently $684 per week, and the total annual compensation for highly compensated employees, and we'll talk a little bit about them, which is currently $107,432. So effective July 1st, 2024, these levels are increasing. So it's going from $684 to $844 per week, which is $43,888 annually for exempt employees and $132,964 for highly compensated employees. Effective January 1st, 2025, that standard salary level is projected to increase from $844 per week to $1,128 per week, or $58,656 annually for exempt employees and $151,164 for highly compensated employees. This law also adopts a mechanism to update these earning thresholds, both for employees who are paid on a salary exempt basis and for highly compensated employees every 3 years. So just backing into that date, July 1st, 2024, January 1, 2025. So every 3 years, we can expect, again, as the law is written today, that those increases will go up. They have not indicated what those thresholds would look like on those automated mechanisms, and I anticipate they are probably still looking at that. So who are considered highly compensated employees for the purposes of FLSA? We've gotten a lot of questions about that in terms of how is that really different? Does this mean that if I have an executive director or some other leader in the organization, does that mean that I have to automatically increase their compensation to $132,964 annually? And the answer is potentially, but likely not. Most of those roles that are considered, again, we'll take the executive director role, they're typically probably going to fall underneath that executive level exemption, and they're going to meet all of those duties tests. So they would fall under, like I said, the executive exemption, which would be subject to that $43,888 number, not the $132,964 number. So I'll give you a little bit of example and maybe a little bit of background on that. So the highly compensated employee exemption was added in 2004. And the difference between that and what we call the executive level exemption is that it's just a relaxed job duties test. So under the highly compensated executive exemption, they have to meet that salary threshold. However, they don't have to meet all of the duties tests that are part of an executive exemption. And we'll get into that here in a little bit. So an example of that is if you had a manager as part of your organization, and let's say they directed the work of 2 employees or maybe 3 employees, but they don't have hiring and firing capabilities. So maybe that has to go through an executive director for approval or the president for approval, whatever the case may be. They then don't actually qualify for that executive exemption, but they could qualify to be exempt, so paid on a salary basis under that highly compensated executive or highly compensated employee exemption. So that would be a situation where you would maybe need to analyze and look at whether or not that you do need to increase their annual salary to the $132,964. The one other thing I'll say about that is it's not actually just their base salary. So you could, for example, take the $844 per week, so the $43,888. You could pay a highly compensated employee $43,888 annually, but then the remaining difference between that and the $132,964, that could be paid in bonuses, commissions, other type of variable type of compensation, but that plus the salary has got to equal the $132,964. So again, a highly compensated employee exemption isn't real common. And like I said, typically employees, like I said, your executive directors, maybe your higher level managers, leaders, they're probably going to qualify for that executive exemption. If they don't, there are other exemptions, and we'll look at those here in a minute, that they may qualify for. The last thing I'll note on this slide is just know that if a state sets a higher standard, so maybe they have a higher salary for exempt employees, then the state law is always going to trump federal. It's going to be whatever is most beneficial to the employee is what essentially is going to be the law. So Iowa does not have any different standards than federal. So luckily, we don't have to look at any other numbers than what we're looking at today. So when we look at who's impacted, we're going to break it down into employers or organizations and then individuals, because it really is a two-part analysis. So the DOL calls employers in the regulations enterprise employers. And enterprise employers are considered subject to the FLSA if they have at least 2 employees and commercial sales of 500,000 or more annually. So some of you may be thinking, hey, we don't have that much in sales, so we're not subject to all of this. We can just continue to go business as usual. And I want you to hold on to that thought, because we're going to talk a little bit more, talk a little bit more about what that means and other commentary that the DOL has stated specifically about nonprofits, but also employers in generally in terms of whether or not you're subject to it. Covered individuals is any employee who is currently in a salary exempt role who makes less than that final threshold of 43,888 in July and subsequently 58,656 in January. Also, like I said, anyone considered a highly compensated employee whose current salary is less than the 132,964 is also going to be impacted by this change July 1st. So just generally, you may be asking, what does it mean to be exempt and thus paid on a salary basis? So salary versus hourly, exempt versus non-exempt. So you'll commonly hear salary exempt as I talk, and then you'll hear me say non-exempt hourly. So typically your non-exempt employees are going to be the ones that are subject to overtime, and that typically you're tracking their hours, that they work, that you're tracking overtime over 40 hours a week. Your salaried exempt employees are typically, they're just paid that salary that you have agreed upon. It doesn't matter how many hours they work in a week. What they get is what they get. So an individual may be considered exempt if they meet all 3 criteria of one of the white collar exemptions. And you can see those listed here on the chart. So when you're evaluating an employee's role and determining whether or not that they can be exempt, you want to go through this 3-step process. So the first step is looking at their current salary. Does it meet or exceed the current salary threshold established by the DOL? If they don't meet that threshold, they need to be paid on a daily basis. The second step is looking at the exemption applicability. So evaluating the role and which exemption it may qualify for, such as executive, administrative, professional or creative, computer, professional, or outside sales. And you can see on this chart the listing, kind of the high level description, I'll say, of what that would be. So for example, executive, that's going to be your presidents, your vice presidents. In a nonprofit sense, it might be your executive director. Administrative, this is the one that probably gets employers tripped up the most because it is very, very vague. Within all of these exemptions, there's going to be a job analysis, and we'll talk about that next. But it's through that process that you're going to be able to determine whether or not somebody can be exempt or not. The one caveat to this is that outside sales. And outside sales, so those who are truly going door to door, making cold calls, not typically going to be working on site at your organization. They're going to be out and about. That exemption actually is not subject to that minimum salary threshold. So you can pay a salesperson commission only, as long as, again, they're truly an outside salesperson. So somebody in your organization that's maybe making phone calls, fundraising, those types of things, that would not count. It would truly have to be somebody that is 100% of the time knocking on doors, out in the field, raising funds, that type of. Professional and creative, that's another one where, between that and administrative, again, it's a little bit of a gray area. But when you think about professional, think doctors, think teachers can potentially fall into that. Other creative artists, those types of things can fall into that. And then administrative, like I said, is maybe a little bit more of the elusive office type of work. But again, per the duties test, it has to rise to that level.
Hey, Kelly.
Yeah.
Can I interrupt you with a question real quick?
Yes.
I've had a couple of questions about the thresholds. Are they just based on salary, or does that include fringe benefits?
Great question. It is strictly salary. So it does not include fringe benefits. Now, I will say, when you look at that salary for, again, I'm not going to talk, setting aside the highly compensated employees for a minute. Anybody else, that has to be their salary. However, up to 10% of that threshold, the 43,888 can be paid through like bonus, commission, some type of variable pay, but it cannot exceed 10% of that annual salary.
Thanks. Sorry to interrupt.
No. Any other questions that have come through?
Not yet.
Okay. So once you've determined the exemption, you can perform a job analysis of the employee's current duties to ensure they satisfy that duties test. And this is, like I said, not entirely black and white. Believe me, I wish it was. So we do always encourage you to consult with your HR professional or legal counsel when you're making those evaluations. I know we have here at Connectify, we have questionnaires that can walk through that analysis. And so if that would be of interest, happy to provide that. And also keep in mind, it's based on what they're actually doing. So for example, if their job description says that they manage people and are making all of these decisions, and this is going to be a dramatic example, but actually they're sweeping floors, it's not the job description, because if the DOL gets wind of it, they're going to come in, they're going to interview your employees, and they're going to ask them what they are actually doing on a day-to-day basis. This actually happened many years ago with Walmart. They had some really like shift managers, and they had classified them as exempt. And when they went to interview them, they found out that they were stocking shelves, sweeping floors. And they got hit with some significant fines and penalties. So it's just important when you're evaluating it based off of what they are actually doing day in and day out, not necessarily what the job description says. So that's why, just a side note, it's really important that you're looking at your job descriptions, you're updating those on an annual basis. It just gets you into that analysis of, okay, do we need to look at reclassifying their roles? Maybe they were non-exempt before, and maybe they've taken on additional responsibilities, and now you can actually qualify them as exempt. So it can go both ways, but certainly, like I said, at least annually or every other year is what we would recommend. And so when you get through that job analysis, if you've got the employee that meets and satisfies all three criteria, so they meet the salary threshold, you've appropriately identified the exemption that's applicable, and you've looked at the job duties test within that exemption, then you should be okay to paying them a salary basis, which means that they're not subject to overtime. So I wanted to just reconnect back on that enterprise covered employer and how that potentially impacts you. So again, as with the individual, it's not black and white. when looking at that $500,000 sales number, for nonprofits, it does not need to include donations, membership dues, fundraising. So for example, if it's a nonprofit and let's say they have a thrift store or something else that helps bringing in revenue, that's the type of dollars that hit this $500,000 threshold. But again, it's not donations, it's not membership dues, it's not money fundraising. So logically, you think you have 2 employees, but you don't have over $500,000 in sales. So you're exempt, right? You're exempt. You don't have to even worry about any of this. Unfortunately, that's not necessarily the case. The DOL has an FAQ document published on their website. Happy to send out that link as well. But it explicitly states there is no exemption for nonprofit organizations under the FLSA or in the proposed final rule. However, and this is the kicker, however, there are certain charitable and other activities that may be considered as outside of the coverage of law. So yeah, like I said, it's not so black and white. The DOL considers virtually every worker as covered by wage and hour laws. And this is due to engaging in commerce, regular day-to-day commerce activities, making phone calls, receiving mail, processing credit cards, etc. So while you may think that organization isn't subject to it, your employees can be subject to it, which then essentially requires the employer to comply with those requirements. So if you're thinking about, I really strongly don't think that we are subject to the Fair Labor Standards Act, I would strongly recommend that you seek legal guidance. I can't express that enough. The ramifications of thinking that you're exempt when you're not can be significant, especially if the DOL considers it willful. Fines and penalties for not complying with wage and hour rules and laws is significant. And like I said, they typically double and triple if they feel that that those decisions were made willfully. So we're just going to pretend that your organization is going to be subject to the FLSA because it probably is, and that's probably how you're operating as it is today. So next thing I would like us to do is look at the impact analysis that helps you kind of understand, okay, we're in this situation, now what? What steps should we take if we've got employees that are underneath that threshold, that salary threshold? What should we do? So option one, the position remains exempt. And so you just go and you increase that salary to $844 a week, effective July 1st, and then again, potentially the 11/28 effective January 1st, 2025. The pros of that, it's going to be efficient for you, just especially when that current salary, if their current salary is real close to that new threshold, and you think that from a financial and affordability perspective, you can handle it, it would probably be, that's probably going to be your easiest route to go. There's going to be no morale issues with impacted employees. There's going to be no impact on benefits. So again, if you can, if it's close and you think that you can manage that financially, that might be the best route to go. The cons of this is just obviously budget constraints. There's impacts to that. There's also impact on life and disability amounts. So for example, if you have a life insurance plan that you offer, benefit that you offer to your employees, and it's 1 times their salary up to 150, that premium for that plan is going to go up because their salary is going to go up. Same thing with disability amounts. If they're getting a higher salary, that calculation and the computation is going to be more expensive for the organization. So just something to consider if you did move that route. There's possibility with morale issues with those who don't receive an increase. So I think there's enough of this out in the world that employees talk, and that's not something that unfortunately you can stop, but just definitely something to consider if you've got employees that some may get an increase and some may not. And then the third con to that is just it can cause salary compression issues. So when you look at how all of your employees are paid, that band and those ranges of where roles fall one against each other is just going to, like I said, it's going to compress because you're raising salaries of individuals that for no other reason, but this you probably would have left the same. Option 2, you can convert the position to non-exempt and overtime is paid. So you move them from a salary basis to an hourly basis. In that situation, federal and minimum wage rates must be met. And there's 3 different strategies that you could do if you're thinking about going down that route, if you feel like maybe this is the best option for you. So strategy 1, you could compute the hourly rate on a 40-hour work week by dividing your current total annual compensation by 2080. The second strategy is computing the hourly rate on total hours worked per week, including overtime. So for example, if you have somebody today that for whatever reason, maybe you're tracking from a grant perspective, you're tracking their hours for the purposes of that grant, how much they're working. And if you're consistently seeing that they're working, over 40 hours, maybe they're working 50 hours. If you used that number to compute the hourly rate to get to that annual salary, that's going to help you probably stay. It's going to be less of an impact on the employee because they're going to be working the same amount of hours. They're going to be getting paid a little bit more, but from that perspective, you're able to control the overtime a little bit more. Strategy 3, you could pay a salary plus overtime. So you could continue. So what in the HR world, we call this salary non-exempt. So you're paying them a flat salary, but then again, they're similar to strategy 2. They're going to be recording and they're going to be tracking their time. And then you're going to go ahead and you're going to pay overtime on those hours that they're working over 40. So there's pros and cons to each strategy. And certainly if you're interested in going into the details and doing a deeper dive on the analysis, happy to do that. I won't go through, like I said, I won't go through all of the details today, but it really comes down to what makes the most sense for your organization. And also really based on the individual roles and the amount of overtime that's currently being performed or that you think is being performed. So like I said, it really comes down to the decision. Again, option 1 is probably the easiest route, but maybe that's not the best route financially. The other thing too that I'll say just generally about these laws, and we'll talk a little bit more about it too, is we just don't know on the January date. Like I said, these things are still wrapped up in court, and so I think news at 7 really on the January, even the July 1st. That's obviously right around the corner, but we've seen before where 11th hour injunctions are imposed and those strategies or those regulations are put on hold. So again, we'll talk about that a little bit in this next slide, but just really want to, from a next steps perspective, kind of look at takeaways and things that you could do for your organization to be prepared if you haven't already. So first step, just to recap, again, evaluating if your organization is subject to the FLSA and the overtime provisions. Again, invite you or encourage you actually to confer with legal counsel and make sure that you get legal guidance in terms of whether or not you're exempt. Des Moines area and even the state of Iowa has great employment labor professionals and counsel. If you need a recommendation of somebody, happy to help with that. We have a couple here that we interact with, and they know what they're talking about, and they would be great resources for you. Second step, again, identify those impacted employees for July and or January. So to recap, for July, it would be any employee who is paid on a salary basis and is making less than $43,888 per year. And for January, it will be any exempt employee making less than $58,656 per year. Once you have your employees identified, And then again, using that impact analysis, you're going to want to determine which option is going to be best for your organization. And again, with this, there's really no right or wrong answer. I mean, obviously you want to do whatever is going to keep you compliant, but of those two options, both are viable, both are appropriate. It really depends on what's best for your organization and from an affordability perspective. Next, you're going to want to prepare a communication plan and strategy, developing talking points for each employee who's going to experience a change, explaining the why behind the what, and you obviously need to do that carefully. If you choose to convert an employee from salary to hourly, know that knowing that they have to then start tracking their hours and punching in and out, they may feel like that's a demotion. I've seen that before. And it really isn't. Their pay is staying the same, right? Likely. They're just being converted to an hourly basis. And so if you have questions, or need guidance or advice in terms of what could those talking points be, I'm happy to help consult with you on that. And then the last thing would just really be determining the communication timing and staying informed. Like I said, at this point, I would recommend only communicating the July impact if you haven't already. And frankly, depending on how your pay schedules fall, if you're not paid until, let's say you're semi-monthly and you're paid maybe in the middle of July, you could maybe even potentially wait until after July 1st to make that decision, just to confirm whether or not the law goes into effect. Again, everything I've read, everything that we've seen in terms of talking with professionals, I don't see it going away. But again, we've been surprised in the past, so it's quite possible. The January threshold, I would definitely wait on communicating that. Certainly start planning for it, especially as you hit budget season. You'll want to make maybe wedges in your budget to potentially increasing those salaries. But I, at this point, would not communicate anything to those impacted employees because, again, it may not end up moving forward, or maybe it's a lesser amount than what they're stating, or maybe it doesn't happen at all. So certainly staying informed, staying tuned until we really know that, until we know that it's definitely moving forward. So that's the basics of really kind of what's happening with the law, things that you need to look at. Like I said, happy to help consult, ask questions, or answer questions here now that we have some time, or separately too, if that works best for you.
Well, thank you so much, Kelly. That was great information. And we can definitely stay on for a few minutes and take questions. And then we thought as well, if you do have follow-up questions, you can always send them to me. You should have received an email from me with the info about today. So feel free to send them to me and we can sort of compile those and send them to Kelly following today as well. But I'll pause there and just open it up if you've got questions for Kelly. Let's see, we've got some coming in the chat. What are some talking points when a transition needs to happen with an employee that's been in the workforce a long time and has an assumption of it being a demotion?
Yeah, it's I think part of it is helping them to know that it's clocking in and clout. I get that nobody likes to do that, but the benefit of it, and again, this really is going to depend from an organizational perspective. If they typically are working more than 40 hours, and again, this may be not something that you advertise, they're going to be eligible for overtime. And so again, they could potentially be making more than what they were making on a salary basis. Again, that's kind of a careful conversation to have, especially if you don't want them to work overtime or they don't need to be working any overtime. But it's really about, it's really just an administrative change. Again, it has nothing to do with the work that they're performing, how they're performing it. The same level of importance in their job duties and their responsibilities is still there. You're just asking them to change how they're how they're determining the time that they work, and like I said, clocking in and out.
Can you talk about part-time employees under the new rule?
Yeah, good question. Part-time employees, so it really kind of comes down to they would also be impacted, but again, typically most part-time employees are going to be hourly, and so the only ramification there is if you've got peak levels of activity where they're working more than 40 hours a week, you should be paying them overtime on those hours.
And then somebody asked if you could make one employee hourly and the other employee salary, even if they're in the same department.
Somebody knows what they're talking about. Yes, that is tricky, especially from a DOL perspective. Typically, the same role should be paid the same way. So both roles should be exempt, or both roles should be non-exempt or hourly. There are situations where you can deviate from that if one was exempt and one was non-exempt, but I would recommend clearly documenting kind of what are the differences between the roles. Is there and potentially maybe the role qualifies as exempt, but you've got somebody that would prefer to be non-exempt. The DOL they're not concerned if you pay a position that is appropriately classified as exempt. If you want to choose to pay it hourly, they do not care, because again, that employee will be subject to overtime and will be eligible for overtime if they work over 40 hours in a week. The tricky situations is if it's a role that maybe isn't appropriately classified as exempt, and that person then is not getting the benefit of overtime, but then somebody else is. That's where you can start to run into concern and trouble, because you've got one person that's eligible for overtime, you've got one person that isn't, and in reality, they both should be overtime. So again, if it's a role that you're confident is classified as exempt, it falls underneath one of those categories, and it meets all the duty tests, by all means, you can pay those. You could choose to pay one as hourly and one as salary. It's just like I said, in those situations, if the role really doesn't qualify for one of those exemptions and you're going down that route, that can definitely cause an issue.
How about seasonal, like summer camp staff? Would this impact them?
Good question. Seasonal is is also a little bit tricky. There are provisions that, depending on the type of work, depending on what they're doing, they can be exempt from minimum wage and overtime requirements. Again, I would want to have a specific conversation and go through an analysis of what they're doing exactly, to understand whether or not that they would qualify for that. But typically they're going to be subject to minimum wage. They're going to be subject to overtime. But again, like I said, there's some specific agriculture, for example. There's some exemptions for that. There's some exemptions for situations where they're like teaching, but it's only kind of on a seasonal, temporary type of basis. So again, there are some carve outs there, but I would want to have a specific conversation about what the work is exactly that they're doing.
A couple more.
I love it.
Suggestions to consider if a role would be impacted in July. Should organizations consider elevating to above the January 1 amount, or would you suggest starting with the July amount and then adjusting if you need in January?
Yeah, I mean, personally, if I was in a seat of decision-making seat to make that, I would just start with the January. And then, like I said, not January, start with the July and then see how January plays out. Unless if it's a situation where financially you can afford it and you're like, I just want to rip the Band-Aid off and I just want to do it all at once, you certainly can do that. Just know that it may not come to fruition, or maybe it's a lesser amount. So just things to consider. But certainly employers are only obligated at this point anyways for the July to make that change. Again, so long as there's no court injunction here at the last minute.
Would an employer consider moving the employee to an independent contractor status, and what are the potential pitfalls there?
Good question. Um, a couple of things come to mind for that. The DOL frowns upon, and the IRS does too, actually more so the IRS than the DOL probably, but they like to gang up on these types of situations too. An individual should typically not get a 1099 and a W-2 in the same year. That is a red flag to them. It can subject an employer to audit if they see that. Again, is the risk high? That is the probability high that that would happen? No, but it's definitely it could be likely, especially if not so more as that they're just coming in and doing a random audit, but potentially the individual that's moving from one to the other, they have an issue with it. Could definitely put you in some water there. When you're looking at independent contractors, the IRS is very, very clear. And again, kind of like the exemptions, has a test and an analysis to go through whether or not somebody can be considered an independent contractor versus an employee. Highest level things like if you're controlling and directing their work, if you're providing equipment, a place for them to work, if they're not doing that work for other clients. So if it's like a good example of that is like a project manager. So maybe they have multiple clients that they're doing that same type of project management for, that moves you into the favor or into the side of independent contractor. But if they're your if you're their only client and this is the only work that they're doing, that makes it look more like it's an employee-employer relationship versus a company and an independent contractor relationship. Decision making. So if you're saying, you have to do it you have to do this job and you have to do it this way, that's controlling and directing. That's not giving them the autonomy to say, hey, I need this XYZ thing done, go do it. I don't care how you do it, just get it done. That would fall more into an independent contractor status versus an employee where you're dictating kind of the process and the steps that they need to use. So certainly an option, but again, would just encourage you to go through that analysis, that independent contractor analysis to confirm whether or not that they qualify for that status.
I think someone's kind of asking about maybe just some additional resources. So I'm going to combine a couple questions, but they asked if there are suggestions on documentation for having the conversation with an impacted employee, like in terms of an HR file. And then they were just also asking if you had any suggestions on resources that maybe we could share with board members who are, processing and understanding this when you think about the nonprofit. So two different resources that they're asking about there. And we could always share those in the follow-up if you do have ideas.
Yeah, definitely. I think we could put those in as follow-up items. I absolutely would recommend documenting the conversation and even maybe going so far as you could put it in writing and have them sign off on it. So kind of like an offer letter, but just I would call it more like a transition letter that clearly outlines that. So like if you're going to move them, let's say you're going to move them to an hourly basis, this is going to be your hourly rate. It's going to be effective July 1st. You are going to be subject to minimum wage and overtime requirements, just making it super clear you're still being an at-will employee, so employment can terminate at any time with or without notice. So all of those provisions I would say would be important to be in that letter. Separate from that, just documenting the conversation. I don't think that necessarily needs to go. I wouldn't put that in the employee file because then if you do, that could be discoverable. Not to say that that's a bad thing, but to me, that would just be more of your people manager or leader notes that you kind of just keep separately, but you've got the date documented. You've got kind of what the conversation was, maybe what the employee's reaction was to that. Certainly recommend documenting that as well. And then if you do make those changes in your payroll system, just again, having that as documentation that you were timely on it. Again, not to say that would come up at all, but it would be important. Certainly too, if you've got a situation, let's say you've got an employee that's on vacation and they're not around for you to even have this conversation. And so their first paycheck is, a little bit down the road, but maybe you owe them pay time off or something like that for that, early July time. You would want to make sure that the updated rate, the hourly rate is reflected, the higher rate is reflected in that compensation. You'll just want to make sure any compensation paid after that July 1st date aligns with that new threshold. And then in terms of resources, yeah, we can definitely, I can send out some things to you, Ellie, to be able to send out to the participants in terms of just links, things to read, things to be mindful of, in addition to the presentation.
Thank you. That'd be great. Can you talk about how to handle the clocking in and out for hourly employees? Like, specifically, how much documentation do you need to maintain?
Yeah, it can be really simple. So, if you have, however you're processing payroll today, sometimes there's a timesheet entry function where employees could just log in and log their punches. Or if you've got a time clock, obviously you're probably familiar. You already have something in place, but even something simple as just an Excel-based timesheet. I mean, you can even go into Microsoft Excel, look at their templates, and there's timesheet templates out there. And so just the employee can use that to document their, the time that they arrive, the time that they maybe punch out for lunch, they punch back in for lunch, and then at the end of the day, and then they sign off on that, whether it's electronic or whatnot, and submit that to their manager in order to be processed before the payroll. So it doesn't have to be complex. It can be something really simple. But I do recommend something in writing. I wouldn't take, an employee just verbally recanting what they worked during the week. You definitely want to have something in writing. And retaining those records, that does become part of the employee file. So you would want to retain those timesheet records for the life of until they left your employment, and typically 5 to 7 years, to cover all of the compliance laws 5 to 7 years post termination.
Okay. I got through all the questions in the chat. So we can pause here and just see if anyone else has any additional. Can you talk about the increase every 3 years?
Yeah. So again, there's a provision in the law that just says, as we know, costs are rising, right? Cost of inflation, just economy and how that's going. So they built into this rule, the final rule, that every 3 years that salary threshold is going to increase. They have not indicated yet what that amount will be. I mean, I would suspect it would be in alignment with inflation and cost of living and those types of things, but TBD on, whether it's that or something else. I could even see maybe it changes to every 5 years. Again, it's written that way now, but that is also part of that's being challenged in the courts and through the lawsuits. There's at least 3 formal lawsuits at this point, in addition to hundreds of states and employers kind of knocking on the door of the Department of Labor saying, you're going to put us out of business. We can't handle these increases. And so that's where I'm saying it's definitely sit tight on that January number, and time will tell on the automatic threshold if that makes sense. Yeah. From a human perspective, it makes sense. I mean, it makes sense that as costs increase, that salaries would fall in line with that. I think, most of I wouldn't say most, I have to believe that majority of the employers acknowledge that they're giving cost of living adjustments, annually, but there's some employers that probably aren't. And that's one of the goals of the Fair Labor Standards Act, is just to make sure that people are being paid fairly for the work that they do, and that they can earn a living and can sustain a living on what those minimum amounts are. So that's really why it's in place, and it's meant to protect. But again, when you've got large jumps like this, especially the one in January, and when you look at nonprofits, when you look at small businesses, family businesses, maybe they can't afford it, and it truly could put them out of business. And so it's important that a balanced approach is taken to it. And like I said, we'll see how that shakes out.
Do you think that the increases would always happen in July, or do you think then they'd move to a January cycle?
Yeah, I think they'll move. I think they would move on a January cycle. I think the July and then January was just a mechanism to try to help employers maybe start to plan for it and make it not hurt so bad initially. But I would anticipate it would be a January. It would be a January cycle. They hadn't mentioned what it is, but I suspect that it will start to align with that the last graduated increase, which would be July or January 1 of 2025. So 2028 potentially would be that first. If it's stuck, 2028 from a budget perspective would be the first time that hits.
Yeah. Yeah.
What else?
We fired a lot at you.
I love it. It's tough. It's when you're not in HR every day and you're focused on growing your organization and taking care of your people.
Yeah.
That's why we like to do these things, is just to help support and give back and help where we can.
We really appreciate it. Absolutely. Maybe while we're waiting, do you want to go to the next slide,
Yeah.
Kelly? And we can just talk about what else is coming up. And then if people have additional, we can hang out. So just a couple of additional things coming up through the Community Foundation. We've got a fun one coming up in July called Yes You Canva. So really exploring how to use Canva. And then our quarterly onboard training will happen again in September. So if you haven't participated in one of those, please consider joining us. So I'll say thank you at this point again to Kelly. We appreciate you incredibly. This has been really great information. So thank you for your time and willingness. I just called her and said, would you do this? And she said, of course. So we really appreciate it. Somebody was asking if you can go back to the slide with the dollar amounts. So maybe we'll go back there and then we can just hang out if you've got additional questions. Otherwise, we will send this recording and the slides out after. So thanks for being here.
See.
One more, I think. Oh, two more.
There we go. This one?
Yeah, I think that's the one that they were asking about. All right. Well, I'm not hearing any more questions. I'm not seeing any hands raised or getting anything in the chat. So we will say a final thank you. You'll see the slides and the video soon, I'm sure. Don't hesitate to reach out to me, Ellie, if you've got any follow-up questions. Otherwise, enjoy the afternoon and thanks for being here today.